If you're a small business, chances are you're managing your finances by checking your bank balance and updating a spreadsheet or two, and honestly, just winging it. That's not a dig at you. Most founders end up doing it this way because no one ever showed them another way. By the end of this video, you'll know what to do instead. I'm giving you the full guide, everything from keeping your books up to date to forecasting your cash to putting money aside for tax so you can run your business with real clarity instead of winging it every single month. I've spent 10 years working with businesses with turnovers of up to £10 million a year, and this approach to managing the finances is what separates founders who are in control of their numbers and can grow confidently from the founders who get caught out by sudden drops in profit and surprise cash flow problems that can ruin their business. Let's get into it. Just a quick heads up, I'll be mentioning Xero throughout this video just because I recommend business owners to use that to manage their finances. If you use a different accounting software, information in this video can still be applied to your business. As the founder, as the business owner, you should be updating the books on a real-time basis. By real-time, I mean it's based on the cadence of your business and how frequently you invoice, how many transactions are in the bank account, and how many invoices are raised, and how many invoices you receive, and so on. But typically, that could mean at least once a week, the book should be brought up to date. And that means not only just raising in sales invoices, right, which is what founders do. What typically happens for small business owners is they purchase an accounting software like Xero purely to raise invoices or to make payment chasing emails, which is fine, but you're not utilizing it properly. Xero should be the foundation for all your financial data. So every month you can crunch the numbers, analyze the numbers, and you can understand what's happening in a month, what your margins are. Did you hit your sales target? Did you hit your margin target? Did you overspend in a particular area? Why did you do it? Is it an anomaly? Was it fraud? Was it a change in a fundamental aspect of the business, of the cost of the business? For example, the rent went up, your raw material cost went up, and so on. So to get to that point, you need to make sure the books are up to date. So that means sales invoices being raised and marked as paid once you've received the payment. When it comes to purchase invoices, you should have a regular routine of forwarding it to HubDoc, for example, in this case, which is Xero's document capture software. Forward it to there, and then go to HubDoc, configure it so that it semi-automatically, processes it. Some transactions need some manual intervention, some don't. For the ones that need manual intervention, you just go in there, change a few details, and it's done. And you should be doing this ideally weekly. If you need to do it daily, but it may not be necessary unless you're a huge business. Make sure you're processing all the bank transactions that are pulled through the bank feed system on Xero, then match the monies received to sales invoices raised, and match the payments made to purchase invoices added into HubDoc. Anything paid or received that doesn't have an invoice or receipt, you find out what it is, you find out if there's VAT on it or not, and then you try to find the invoice. Or if it's a transaction you're not aware of or you don't know what it's for, then you raise it, you add it to your list of things to chase up or check on. That's the top level summary of what you need to be doing on at least a weekly basis to keep the books up to date. The point of keeping the books up to date is that so when you get to come to the month end, it's easier to assess how the business is actually doing. Typically founders leave it for months on end, relegating these finance tasks, the bookkeeping, down to the bottom of the tasks, which just makes sense because it's not exactly super high leverage. Although by doing this, having this routine, you will be in control of the numbers. You'll understand what's happening and what needs to change. Now, this next point trips up almost every business owner, and is the reason why you can't use the bank balance as a way to judge how the business is performing. If you have a lot of cash in the business, doesn't necessarily mean the business is doing well. And so at the end of the month, after you've done all the bookkeeping, let's say you've been doing it on a weekly basis, at the end of the month, you need to assess the performance in that month and compare it to previous months and compare it to what you expected to achieve in a month. You need to make adjustments to the figures to show what's actually happened in the month instead of just what's been raised and the cash received, right? For example, let's say you're a service business and you've sold 6 months of service in the month of June. You've raised the invoice for all 6 months in that month and they've paid, right? So in the books, let's say the services are £6,000 for 6 months of service. You will see 6,000 in the month of June as sales, but really you should only see 1,000. So in accounting, it's called deferred income, so where you do a manual journal, right, in the books. This is getting a bit technical, but that's what you need to be doing. It's not too technical, it's not too high of a level, you should be able to do it. Of that 6,000, you move 5,000 onto the balance sheet as deferred income. So deferred income just basically means income to be shown in future months. Simple as that. Because you don't want to see 6,000 there, because let's say, for example, your target is 5,000 a month, and you see 6,000 there, you'll think, oh wow, I'll be done well in that month. But really, you've only sold £1,000 of services in that month, because that's the amount relevant to that month. That's one of the reasons why you need to make a journal and adjust the figures that are being shown on your profit and loss account. And the same goes for expenses. Let's say you're a product business and you've bought £10,000 of raw materials that you use to create your product. If you only show that in, let's say, in the month of June, it will skew the figures because you don't use that £10,000 worth of stock all in that month, right? And this is where the concept of opening and closing stock comes in. Once you purchase that stock, £10,000, let's say it's £1 per item, that's 10,000 units of that raw material. And in that month, you've only used 1,000 units, let's say, for example, to create a bar and sold it. That means you've got £9,000 left. So again, you do a journal, show closing stock of £9,000, you show it on the balance sheet as an asset, £9,000 of stock or inventory. whether you call it on your balance sheet. That basically means you have £9,000 worth of stock in hand that's going to be sold as goods in the following months, right? So then that creates an accurate picture of the current position of the business. You spend 10,000 on the raw materials purchase, you've only used and sold £1,000 of it, so you still have £9,000 left. And so in the next month, let's say you use another £1,000, you would have an opening stock of 9,000 and a closing stock of 8,000, and you would keep doing this process until either you add to the stock or you run out of stock. This is important because if you don't do that, then the margins that you see every month won't be accurate on zero. If you're accounting for opening closing stock on some separate software, fine, but in zero, you want to be able to open up zero, go to the P&L and see in the month of June, for example, you've sold X amount for X price. In the direct cost or cost of sales, you will see the cost of the stock related to those sales only. You won't see other costs. Sometimes the reverse of deferred income happens where you're owed money but you haven't raised an invoice. This is quite rare, but the reverse can happen. Prepayments, quite typical. Let's say for rent, you're charged 3 months in advance. Let's say they raise an invoice for all 3 months. You need to split that over 3 months. You do it in the same way with one manual journal. So a manual journal just means a manual bookkeeping entry into the system. It's not really a simple way to explain it. It's basically where you can move figures around in the books to show what's actually happening in the business. Say you have 12 grand of rent for the quarter, 3 months. So you should be seeing 4 grand of rent every month in the books. If you're not seeing that, then you're going to have lumpy expenses. When it comes to actually assessing what's going on, and you don't really have an accurate picture, and then it becomes harder to identify any issues when you're comparing actuals to actuals. So 1 month to the next, or 1 year to the next, and so on, or actuals to budgeted. So let's say you expected to spend X amount of rent, but you actually spent this month. Actually go in and assess the numbers on a monthly or quarterly or annual basis. It's going to create a difference that's not really due to anything except not putting in the journals to make sure you're on a accrual basis, basically. Very technical-ish. It's quite technical. Some people would say, you don't really need to do all of this stuff to have a successful business, but I disagree, because essentially it means you're winging it, really. You might know who owes you money. You might know top level, like how much you've sold to date, maybe, but everything else, you have no idea. You don't really know what your margins are. You don't know what your cash is going to look like in 3 months. You don't really have a 12-month plan to execute or to follow and to compare your performance against. And then you delve deeper into why this is happening, because if master finances are managed properly, it is the basis upon which you can improve the business. But to get to that, there's a big gap. So you need to do all these steps, and the next couple of steps I'm going to speak about to do this. Someone needs to be doing this stuff. Either way, anything up to this point feels like a lot to manage. On top of actually running the business, this is exactly what we take off your plate. Book a discovery call and let's build a clear and easy plan to get the finances under control for good. The next important step is categorizing expenses consistently. So you want to make sure that not only expenses, actually all line items in the books are being coded properly, because then when it comes to crunching the numbers, key thing is you want to avoid differences in figures that are purely down to inconsistent coding, because then it hides issues. The example is if you have some kind of IT subscription like Google Workspace or Microsoft Teams or something like that, or OneDrive, something like that. 1 month you code it to subscriptions, and the next month you code it to IT, and the next month you code it general expense. You're going to have kind of inconsistent, inaccurate comparison between months. And then when it comes to looking at the numbers, it doesn't really make sense why there's so many fluctuations. Part of this is actually using manual journals to accrue for expenses. So like in a rent example, let's say you know that your rent is £1,000 a month, but you haven't been issued an invoice, so you haven't paid. You need to still show that in the books, because that payment will be due. You know it's going to come. It's just that the invoice hasn't come, so you haven't accounted for it. Right? In the books, you do a manual journal, show £1,000 as your rent in that month, and then in the balance sheet under the accruals code, you would put £1,000. Accruals means potential expenses you owe or yet to be made. So you need to show that every month, and by doing that you create an accurate picture on a monthly basis. Then you can crunch the numbers, you can assess the numbers, and you have a clear picture of what's happening, why it's different to what you expected, and what you need to change to take the business from A to B. Yeah, and another point is make sure you're uploading purchase invoices when you receive them, not when you pay them. I've seen that before, where purchase invoices are held back for some reason because maybe there's a poor understanding of what needs to be added to zero in this case. When it comes to managing the finances, key point is that you need to know what your margins are. What I touched on previously, the point about the accrual basis and the cash basis. This is all in an attempt to calculate what the actual margins were in every month. And by margins, I mean profit margin. I mean gross profit margin mainly. That's the main margin you need to focus on, really. Overheads are easier to deal with. It comes to how much gross profit you're making and does it cover the overheads, and then leave you as the business owner or the founder at the end of the year with enough money to pay yourself whatever you think you deserve. Know your actual gross profit margin, and you do that by making the adjustments every month in the books to reflect what's actually happening in the month, and then you can see what your gross profit margin is. And again, going back to the opening and closing stock example, by doing this every month, and if it's a product business, is how much you've sold in a month, what the cost of those inputs were, so the raw materials, shipping, packaging, any labor associated with making the product, they go in cost of sales, and then you get the gross profit in that month. And then you have the overheads in that month. You have rent and salary, the main ones probably, your salary, your IT costs, and so on. So those will all be overheads, and that's it. So you can see that every month. If you do this every month consistently, You'll have 6 to 12 months of clean data to base your next decisions on. So you have that data, you compare it to what you expected or what you aim to achieve, why it's different, and then you make decisions based on that. But when it comes to margins for a service business, it's trickier because the key cost of sale or the direct cost is labor. Let's say you're a construction company. You've got staff that work on the project. Let's say they're building an office block. Yeah, all right. So anyone working on the actual building site is a direct cost. And then anyone, let's say the receptionist in the office or the bookkeeper in the office or someone in marketing, those would be an overhead. And you need to make that split clear in the books so you can actually see your gross profit margin. This which is the important one. So if you're charging X amount for building an office block and then you're paying out to contractors or subcontractors X amount, your margin should be shown on zero once you've done the adjustment. You show what's actually happening in the business. That's it. In the service business, the main cost of sales, the main direct cost is salary, usually anyway, unless you're a SaaS company maybe. Even so, when it comes to maintaining the SaaS, you're probably paying XYZ coder, IT technician, developer to maintain it. So that would be a direct cost. Overheads are typically marketing, admin, finance, HR, and so on. These kind of people. Overheads, anyone directly associated with the delivery of the product or service, direct cost. So in service business, it's a bit more trickier because there can be overlap. A staff member can be doing all things actually, especially in a small business. To get your accurate picture of margins, really you should have a time sheet. That's a broad overview. You don't have to be too detailed. Just gives an overview of what you've been doing, whether it's marketing, whether it's sales, whether it's operations or delivery, whether it's finance, whether it's HR, and so on and so on. The key thing is, in a service business, you want to see how much time is going towards delivery and how much time is going to other stuff. The idea is there's two ways to be more productive. Your staff in the service business spend less time delivering but maintain the quality of service, and reduce time on, let's say, non-income or revenue producing work. So let's say admin, let's say finance, let's say marketing. What ways can you improve output and reduce time spent? It could be through automation, it goes through AI, through software, and so on and so on. And by doing that, you improve the margins, basically. Simple as that. When it comes to knowing your margins, look, what I've seen is most business owners know their margin in a theoretical sense, meaning they've planned it on an Excel sheet. Yeah. Okay, I'm going to sell for £10. I want to make 30%, so I'm going to spend £70 on delivery, salary, or raw materials and so on. And then my margins are this. So that's why my price is that. But when you actually look at the figures, you actually find out that you're actually making less money in areas that you thought you were making the most money. And where in the areas where you thought you'd make the least money, you're making the most money. And that's why it's important to actually look at your numbers, keep them up to date, make adjustments so that they reflect what's happening in the business in that month, what's relevant to the business in that month, make sure everything's coded accurately. And then based on that, you can produce a profit and loss account. You compare it to what you expected to happen or what you wanted to happen, so your targets. And then you look at why these two figures are different, what you need to change, what you need to focus on to meet your targets or meet the expectations. And so this is a summary of how you actually track profit, but it's more complex if you have more service lines and you have more product lines. The more service lines, the more product lines you have, the harder it is to track and the more accurate you need to be with allocating costs. Because if you don't do that properly, you might accidentally make one service line or product line more or less profitable than it actually is. And so in Xero, for example, there are ways to track costs against sales. That's more advanced, and generally speaking, you can get a good general overview of what's happening by doing what I've said. The next point builds on all the previous points, and that is to have a monthly reporting routine. You shouldn't skip it for whatever reason. It should just be a normal routine that you execute every month to make sure you actually look at the figures, look at what's happened in a month, what you expect it to happen, why it's different, and then you discuss and you dig deeper into what you need to do, what you need to change to achieve what you wanted to achieve. The key point is by doing this monthly cadence, you'll be on top of the finances. You'll know what's doing well, you'll know what's doing bad. This is also that you can see issues much earlier on and address them ASAP. If you don't do this, usually your profit drops and you don't really know why. Cash becomes tight and you don't really know why. These are 2 points they need to stay on top of. Sales, everyone's looking at sales. Every single business owner in the whole entire world loves to look at sales, target sales, focuses on sales. As long as we hit this sales figure, we're fine, which is not the case. Business is more complex than that. You need to be looking at profit margins, which is harder to find out. It takes more time, more accuracy to actually dig deeper into the sales figures and to determine what the profit margins actually are. And that's where you're making your money. You're not making money on sales per se. Sales is good. You can sell £1 million in a month. What do you do? If your margin is 1%, you're screwed. If your gross margin, so margin after direct costs or cost of sale is only 1%, that's what? That's 10K? Yeah, it's 10K. 10K to cover all your overheads. I'm sure you have more than 10K overhead, including your salary. So this is important. Margins are the key. You need to be assessing them on a monthly basis. That's one of the key reasons why you need a monthly reporting routine. You don't want to be selling something and then 6 months down the line, you barely made any money on it. What's the point? With one assessment based on one set of accurate, complete numbers can lead to you making more money or not losing money unnecessarily. The basic monthly reporting routine is you do the bookkeeping, you make the adjustments to make sure every month shows exactly what is relevant in the month. Once you've done that, you take an Excel report from Zero, because within Zero it's quite limited on what you can do. So Excel is better, or Google Sheets is better. You export the P&L and balance sheet from Zero, put it into Excel or Google Sheet, and from there you build a simple reporting pack which has the P&L actual figures, has the balance sheet actual figures. You have a rolling cash flow forecast, and then you have maybe another tab or two that covers specific metrics to your business that are relevant to your business, such as ad spend, ROAS, LTV, CAC. These are all technical jargon. Entrepreneur. If you're in the entrepreneur world, you know what these mean. If you're not, Google it. It's quite simple. And then you can compare actuals to budgeted. You can compare actuals against previous month's actuals or previous year's actuals. You can see the differences. Are the differences big or not? If there are large differences or not, whether they're significant or not, you can look at the numbers, assess what's happened, or why, get a reason for why there's a difference, whether good or bad. Actually, it's good to know both sides. And then you can make decisions about the business, whether that's pricing, whether that's changing your marketing agency or changing marketing approach, whether that's changing your offer, whether that's finding new suppliers or new contractors, or so on and so on. There's many decisions that can come off the back of having accurate and complete records and reviewing them every month. By moving into Excel and Google Sheets, it's even easier nowadays to crunch the numbers, because you can use AIs like Copilot and Gemini, which are built into Excel and Google Sheets. So there's less of an excuse for you not to do it. As part of the monthly reporting pack, I did mention that you need a cash flow forecast. That's one of the standard reports you need to be developing and reviewing on a monthly basis. So typically I recommend a 3-month rolling cash flow forecast, because the reason for that is the longer out you forecast for, the more inaccurate it's going to be. So then therefore the less useful that information is. But doing it 3 months ahead on a rolling basis, so every month you add the next month, right? So let's say you're in June, you forecast July, August, September. When it comes to July, you add October. When it comes to August, you add November, so on and so on. This is so you take the actual cash basis figures from Zero, because what's good about accounting software is you can toggle between accrual and cash basis. Basically, it means you can see what your turnover is on a cash basis, so how much money you received, how much sales money you received, or how much revenue you received in cash terms, how much you've paid in cash terms, and so on and so on. This is useful for the cash flow forecast, not the actuals forecast, which is completely different. Actuals, accruals, I use the terms interchangeably, but yeah, that's what it means. The process for creating the cash flow forecast is you go to your Zero, go to the P&L and balance sheet, you switch the toggle from accruals to cash, export that to the Excel sheet, and then based on that, you add the next 3 months. And then let's say in this example, it's the end of June and we want to forecast July, August, September. When it comes to sales, it depends on the business. If you're starting from Zero every month, then what you would put in there is a target figure, because you don't have anything else to go off. You could either do target figure, you could do previous 12 months or previous 6 months of performance, and that's the average. Okay, we expect on average to hit that. Maybe last year's figure you could put into there plus X% as a target, and so on and so on. So it's just there for a rough guide. But ideally, what you would do in a forecast, there's forecast is 3 months. You would work backward from opportunities that are closest to actually being closed. So if you're a product business, let's say you have a 12-month contract with a wholesaler, you already know you're going to make X amount of sales in that month, so you would add that to the forecast in that month. If you're a service business and you've got a 12-month package with someone, you know you've already sold X amount in that month, so you can plug that in. That's guaranteed, basically. Next level down is deals in the pipeline or sales in the pipeline that you know you're quite close to closing. You would plug those figures in. Then what I would do is I would have an overall target anyway, and then the difference between your overall target in that month, sales target in that month, minus sales already made, minus sales with a high likelihood of landing in that month. That difference is just there for you to understand that there's a gap of X amount. If you go to your CRM, you should be able to see all opportunities that have come across your desk or come to the business. The main purpose of the cash flow forecast is so you can predict if cash is going to be tight in the future. Another point that I haven't raised is you should have a cash reserve figure in mind so that the business can survive X amount of months without receiving any money. So that's typically 3 months of overheads. If it's that bad where you're not receiving money after 3 months, then it must be some kind of fundamental issue in the business. So that's why that's kind of a good measure to have. 3 months of your overheads. Or let's say you spend 100k on overheads per month, you need 300k in a bank. Saved away can be used in very bad months. And then that reserve value or coverage increases depending on the size of the business. The smaller the business, the smaller coverage you need, so on and so on. And then that buys you enough time to make decisions to recover the situation. Forecast is a bit more flexible. You can keep changing it to tweak it and make it more realistic. And the more realistic it is, the more you can rely on it, the better clarity you have in the business, and then the calmer business is. And then you can focus on other aspects of the business instead of focus of stressing about how to get X amount of money in. Where's this money going to come from? Oh, we've got this big payment coming. I have no money. So by doing this, it buys you a lot of time to plan ahead and foresee any issues and deal with them in good time. Less stress, more clarity, and more confidence. So overheads, when it comes to forecasting those, most of them are fixed. Salary's fixed, rent is fixed, you're going to pay every month. IT subscriptions fixed. Advertising usually is fixed, so you would forecast the same, roughly the same as the previous 3 months up to 6 months or 12 months, unless you actively know there's going to be a change coming. So let's say, for example, in 2 months you're going to hire someone, you know that the staff cost will go from X to Y, so you plug it in. And then you can see the actual impact on your cash balances. 6-month cash flow forecast, it might be useful, it might not be, it depends. Toy around with it, see if it works for you or not. But minimum 3 months is good for most small businesses. And another bonus of having a cash flow forecast is once you've plugged in the overheads, you know that these are basically fixed costs. You don't have a choice to pay them in that given month. So you know that every month you need to be bringing in X amount of cash from your sales. It gives you the ability to work backwards from your costs, and then you can determine your actual targets you actually need to hit. So your break-even target, for example, that's what it's called. Rolling cash flow forecasts are flexible. You should always amend them to reflect any changes or any realistic foreseeable events that will happen. You can amend it and then review the cash position and then see what you need to change elsewhere to make sure the cash position is better. So whether you have to delay your own payment as a founder, whether you have to delay investment into some kind of machinery or marketing or whatever you can see that clearly with the cash flow forecast. And the next point is, let's talk about putting money aside for tax. Kind of linked to cash flow forecasting, but basically the basic premise is you work out roughly how much of the income you receive would need to go to the VAT man and how much would need to go to the corporation tax man. Same guy, I think it's a guy. Let's say it's a guy. Same dude, same company, same organization, sorry, HMRC, but VAT is something you need to be wary of. You shouldn't be going late with VAT because it's not your money, it's the government's money. And they're very strict about you paying that. So it's best to, let's say for example, you know that on average, every 3 months, if you're doing quarterly returns, every 3 months, you pay 16% of the sales money you receive to HMRC. And that's after taking out VAT reclaim and so on and so on. So every time you receive money, you take 16% of it out, put it into a VAT pot, VAT pot. The same premise goes for corporation tax, kind of. As you're going along, you will be able to work out what your profit is going to be, and then therefore what your tax will be. You do have 9 months after the end of your accounting period to pay it, so there's a bit more flexibility. So in those 9 months after the year end, you should know really within a month or so after your year end what you need to pay, and then you can start putting money aside for that as you're going along through the financial year. We can use the same kind of method to calculate roughly how much corporation tax you would pay if your profit is at whatever level based on the actual figure. So you would extrapolate from there. So let's say 6 months, you made 100k of profit. You can say, okay, let's assume that it's going to stay on that level. Then you'll make 200k. And if you make 200k, then that's going to be charged at 25%. So you need to be putting 50k aside from sales money received. You can put that into cash flow forecasting. You can make a note of it somewhere so that you know eventually this is coming and you need to put money aside. One of the ones that is often overlooked is dividends tax. So if you're a founder, you're probably a majority shareholder, if not 100% shareholder, you take money out via salary, 12,500, and dividends. On that dividend portion, you will need to pay personal taxes later on in the year. You don't pay it in the same way as you pay when you take a salary, which is in real time. Every month they take the salary up front. In dividends, you pay it later in the same way a sole trader would. So you need to account for that in the books as well, depending on how you're going to pay it, because what tends to happen is the founder who's taking out all the money doesn't account for the personal tax that they need to pay. So really, that money you're taking out, you should put aside some of it in the personal account for the tax that's coming. But they never do. Well, they rarely do that. And then what tends to happen is every year, they take an additional dividend payment to cover the tax on the last year's dividend. So what happens in the current month is you have more dividends coming out. So let's say you're already at 50k and then the tax is about 4k, 5k that you need to pay. You're going to push your total income to 55k, then you're in the higher rate tax, and then every year you keep repeating the cycle until you hit 100k if the business is going well. The reason why you want to plan for this is that if you have a bad year, suddenly you need to cut your dividends because you can't sustain that level because the cash is not coming in, but you still owe the tax on the last year's dividends. So let's say you're at 100k total tax, that's a lot of tax to pay, you don't have the money, and then you're reaching down the back of the sofa, you're cutting costs left, right, and center to pay your tax. And this is unnecessary stress, and it's something you should be aware of. And if you do want the business to pay it, then you need to forecast out what taxes will be due, when they'll be due, and then look at the impact on the business's cash flow as a whole. This is more pressing for smaller business, even though the owners of bigger businesses tend to take out more money, and therefore they owe more tax. And then one bad year, they got tax coming out the wazoo at the back end. They got a lot of tax to pay, and then they're blaming X, Y, and Z people, but really they should have taken responsibility for their decisions, and taking that much money out without paying the tax or without accounting for the tax element means that it's a disaster waiting to happen. So either account for it in the business cash flow or your personal one, even simple as that. And also, yes, you want to be successful and you want to make as much money as possible, and when you do make money, you want to take out as much as possible. But one point is, you probably don't want to increase your standard of living too quickly. There should always be a lag behind it, because if you don't have any buffer when it comes to cutting personal expenses, you will struggle. Everyone around you will struggle. Suddenly you can't do what you used to do. You can't travel like you used to do. You can't buy stuff. You can't eat out and so on. But a lot of people actually struggle to reduce their standard of living. Once it increases, it's hard to reduce it. It's more psychological thing, but that's how I justify my kindness. But it's a good general rule. Don't count your chickens before they roost. Is that what they say? Don't count your chickens before they hatch. One bird in the hand is worth two in the bush. I don't know if that applies, but cool. And the final point is to summarize everything and to nicely package everything. Is the reason why you need to manage your finances properly is because you need to be able to use the financials, the numbers, to make decisions in the business. Every big decision you're making in a business should be accompanied with some kind of financial report, some kind of financial justification of why you're doing it. There should be some kind of scenario planning. There should be financial backing or some kind of numbers-based backing of the decision. The key points are, you're comparing actual performance against your budget, comparing actual performance in 1 month to the next month, comparing actual performance in that 3 months to 3 months, 6 months to 6 months, 12 months to 12 months. Yeah. And based on the differences you see, it should tell you a story about how the business is performing, about the decisions you made during that period, and whether they worked or not. And if they didn't work, why they didn't work? What are having the biggest impacts on your business from a financial perspective? And does that correlate with what you think when you're in the business day to day? Is it a leads issue? Is it an offer issue? Is it operational issue? These are the 3 core areas that you should be able to dive deeper into based on the assessment of the numbers. That's the key point of it all anyway. The best way to do this is to have a monthly discussion about what's happening, and from a figure standpoint, to ensure you're adapting to situations in real time instead of late. You don't want to find out there's an issue 12 months later, because that's 12 months of wasted time, 12 months of lost profit, 12 months of cash being super tight. And then that cash being super tight normally means, well, in most smaller businesses anyway, it means that the founder's under pressure, personally as well. Personal finance is under pressure. Then you get the usual kind of pressure on the business, and in your personal life carries over to personal relationships. So this is why you need to be on top of it on a regular basis and then make decisions that actually are likely to improve the situation. And then once you make the decisions, actually, you can, after 3 months, let's say, you should be able to see whether it's having an impact or not. You should understand what impact it should be having, those decisions, and whether it's actually being achieved or not. And if it is being achieved, good, you carry on. If not, you tweak and you amend and you keep going. This is all an effort to understand what's happened, forecast or predict what's going to happen. Book insights you should be getting are, why is your gross profit margin dropped? Is it for a one-off reason? Is it, there's an Iran war, for example, what kind of wars going on in a region affecting shipping and manufacturing, all the materials you're using? You should be spotting drops in margins. Obviously, drop in sales, everyone knows there's a drop in sales. Every founder in the history of humanity, every business owner knows when their sales are low or high. So that's not really what you want to focus on when it comes to reporting. It's part of the picture. You focus on that already, so we don't need to focus on that much. You need to focus on which product, which service makes the most, which one makes the least. Why is it the most? Why is it the least? Can we take the lessons from the ones that are the most and apply it to the ones that are the least? If so, let's experiment, let's try. Change the offer, change the way, maybe the formula, maybe you have a product and that flavor is not performing well. Maybe you cut it, maybe you change it, maybe turn it into a luxury, maybe turn it into a one-off. You experiment and try to find ways to improve the margins. If it's a service, maybe you implement some kind of software, AI changes to improve the deliverability, but reduce the cost of deliverability. So you increase the quality and you reduce the inputs. That's it. You could try every month. Sales will be X, Y, and Z. Cost of sales will go down by a bit because of these changes, and capacity goes up, and then we expect sales to be this level, for example. That's the basic summary of how you formulate, how you create a budget. Budget is more about having a conversation, discussing the overall plan of the business, and putting numbers to those plans. When it comes to strategy as well, and you need to determine where you're getting funding from. How will you fund investment? Will it be from the profits of the business? Will it be debt? Will it be equity? Will it be your own personal finances going in? That can be helped by having the cash flow forecast readily available, making sure that all the figures are up to date and the actuals are accurate and complete. Biggest benefit of doing all of this is that you have full clarity about the current position of the business and the likely position in 3 months, and what the plan is going forward to improve the business. Those are the key points. Once you have those, you'll be more confident in the direction the business is going in, and less stressed. If there's one thing to take away from this, it's that clarity around your numbers is not an option. It is what actually lets you run the business instead of winging it and operating on gut feeling. If this all feels like too much to handle on top of running a business, or you're still a bit confused, book a discovery call using the link in the description. We'll break down your finances and build you a clear and easy to follow plan so you can get your finances under control for good. If you want more videos like this, make sure you're subscribed. I've got plenty more coming. See you next time.